Another wild ride on Wall Street today as stocks give up some pretty substantial gains from the early session. The Nasdaq had been up as much as 3.4%, but ended the day flat. The Dow swinging 940 points from high to low. The move coming after Fed Chair Jerome Powell set the stage for a rate hike in March. And check out the spike in yields. As he spoke, the 10-year yield soaring back toward 1.9%. We're at 1.873 right now. So is the Fed put truly kaput? Tim, I'll go to you on that.
You had to do that, Mel, and good for you for doing that. So and good for Jerome Powell for doing it. And the question is he doing enough? And I would actually focus at the short end and the middle part of the curve, the belly they call it. But again, 2s and 5s, and without getting too lost in that, just look at the short end. Look at where we went essentially in the last 24 hours from 1% to 115. So the market's almost dropped in 2/3 of a 25 bip. Hike right there. I think the focus here that investors and the world is looking at out of the Fed today was reminding that the labor market may be the most important bogey for them right now. And again, they've always talked about the labor market, but the move from 5.9 to 3.9 on the unemployment rate, but more importantly, the labor cost inflation is something that the Fed knows better than anybody is the stickiest part of the inflation story. So I think this is a day when, although it was a non-event in terms of the announcement, obviously the market read into the Fed chairman's comments, and the sense was that they are less concerned about market dynamics, and I would agree with that as well.
All right. It was an interesting day in terms of all the asset classes. I mean, we saw markets go down, Steve. We saw yields go higher, and we saw oil stubbornly high as well on a day when Brent hit $90 a barrel for the first time since October of 2014. The dollar also up. These are all things that are not necessarily good for the markets.
Yeah, but I think the market. You never want to say the market gets it wrong, but we've experienced the FOMC and Chair Powell talking hawkish but acting more dovish. The market has already established that they will stop asset purchases, they will raise rates, and they'll let the balance sheet run off. That's not all happening all at once, and I think that's what they've factored in. I think the sell-side banks are tripping over themselves, saying there's going to be 4, 5, 6, 7 hikes. They're trying to outdo themselves. I think this is a great setup for the market. It's pulled back. Chair Powell has confidence in the economy, is seeing through Omicron, and I don't think this is going to be as bad as people think. Look at the front end of the curve, like Tim said. If he talks more dovish, what happens? The front end comes down, and then the back end will steepen because they won't be afraid that he's going to overstep and create a recession. EEM, emerging markets, will do better. Value will do better. Banks will do better. End of story. I think he's got to get off the hawkish bandwagon just a bit for markets to start performing a little bit better.
To quote one of Pete's favorite songs, everything's coming up roses. Pete, it sounds like in Gross's scenario, it's a win-win-win situation pretty much if he even turns a little bit less hawkish, and that all this hawkish talk is just jawboning. What do you think?
Just jawboning, that's right. Well, Mel, I think for a long time, everybody's just looked at so many different aspects of the market, and obviously everybody has a very big concern about all the different areas of the market right now that are getting hit from all areas as far as catalysts go. But the Fed being one of the biggest hammers out there, as a matter of fact. And so, it was an interesting reaction today. The markets were absolutely on fire. They started to really sell off pretty harshly. And I thought that was pretty interesting how actually the Nasdaq hung in there pretty well, relatively speaking. So, it's interesting. It's always going to be interesting. I mean, everything's coming up roses. I'm not sure that's always going to be the case, but it certainly, it felt like that's something looking out, that's something that they're looking at right now, that everything can be roses, and we'll see if that's really going to play out the way they think. The labor market is strong. That's something that they talked about time and time again, and there's no doubt about that. But to your point, Mel, oil and a lot of different other aspects of the market sure do cause a little bit of, some waves in that what seems like calm water that we're talking about right now.
All right. For more on the Fed, let's bring in Steve Leisman, our senior economics reporter. Steve, what did you make of Powell today?
I thought he did pretty much what he told us was going to happen. I thought it was pretty much hitting the nail on the head. A little bit, maybe a touch more hawkish in terms of releasing that principles of balance sheet reduction. Not something I expected, but I did expect them to talk a lot about the balance sheet, so they just did it in a more organized way than I think the market expected. I think I had an expectation that perhaps this summer they would be reducing the balance sheet, hiking in March, so I think it was pretty much spot on. I will tell you, Melissa, in just the last, I don't know, little bit here with this rise in rates, I want you to look at the Fed funds probabilities because there has been a change in the market outlook. We went into this meeting with the expectation that rate hikes would be quarterly next year. They've now moved that up. If you guys can show that chart, thank you very much. There's now a banking here or pricing in of 3 consecutive rate hikes with only a break before the 4th here. Now, it looks like that June one could change a little bit. It's not quite as strong as the others right now. And this is pricing that does move around, sometimes by the hour, sometimes by the day. And you can see the November hike, or the 4th hike, is now in November. It had been in December. So they've made more, the market now pricing in more frequent rate hikes, as well as an earlier 4th hike there as well. So I'm not sure I heard that, but I can get how that could happen, that the market thinks the Fed's going to get its business done. Maybe the upside is I don't see them pricing in a 5th hike here, at least not at this point yet, at the February or December meeting. So pretty much as expected. I'm a little bit concerned that there were a lot of people out there saying that they thought Powell was going to ease off and be dovish. I don't know why they expected that. I'm a little concerned that people were talking about that out of school a little bit.
Yeah, there's really no upside at this point to going more dovish when the markets are expecting 4. I mean, why not just let the markets think 4? And if you deliver 4, you deliver 4. If you don't, so be it. That's the way I took it.
Right.
But you know much better than me, Steve. So let me get this straight, that November hike that's now priced at 70+% probability, that was really a December originally, and it's pulled forward?
It was December, yeah.
Yeah.
Pretty strongly now pulled forward into November.
Based
I will say
on
one
today.
thing, though, that's probably, based on today, one very quick thing, which is Powell has clawed back some optionality for the Fed and some flexibility. This is not baked in so much anymore. They may do more, they may do less, but the guidance now is substantially different. They had the guidance during the pandemic was we are going to be easy for a very long time. They're now saying they're going to hike, they're going to do the balance sheet. But I think the guidance, the window now is more like 6 months, not a year the way it had been before.
All right. Steve, thanks as always.
I think.
Always good to see you, Steve Leisman. We do have some stocks moving the after hours that we want to get to right now. Christina Partsinevelos is here with all the highlights. Christina.
Well, that's right. I've got a few breaking news stories just in after hours trading. Firstly, a new member of the S&P 500, Constellation Energy, is going to replace the Gap. Constellation Energy shares right now climbing higher, about almost 5% higher. Unfortunately, the Gap is moving the opposite direction, down 4%. Gap will be moving to the S&P Mid-Cap 400. Keep in mind, just about 2 weeks ago, Constellation executives put out a press release saying that they're going to emphasize nuclear energy in the future of the company, and a lot of analysts are bullish on that company in regards to that. Second story, shares of Centene popping roughly 6% right now after a Bloomberg report said that the company has drawn interest from Cigna in recent months. We've reached out to both companies. We haven't heard back just yet on this report, but nonetheless, that's why you're seeing movement in these company stocks right now.
All right, Christina, thanks. Christina Partsinevelos. Pete Najarian, your pick on which stock you want to talk about.
I'd probably lean towards Centene. I think that, we talk about this space a lot in healthcare and so forth. And you know what? Anytime I hear somebody's interested in something like this and the possibility of it being there, that's something we all want to look into and find out, is there any credibility to that or not? So I think that one stands out the best for me.
Yeah. Tim, Gap?
Not so much. I mean, look, I think it's a case where forget the technical aspects of the leaving and adding dynamics for whether it's Constellation or Gap. I just think that Gap is a story that was a restructuring, broken story, so to speak, not restructuring from a balance sheet perspective, but restructuring in terms of what they're doing with their retail footprint, what they're doing with their mall leases, what they're doing with their brick and mortar versus their online business. I think you squeezed a lot of excitement into this stock, and I don't think there's a lot of excitement in the next 12 to 15 months. I also think margin issues around labor and even higher real estate costs are things that people are not pricing in aggressively enough.